Hi there. Good evening, good evening, good evening. You are welcome to The Real Issue with Ayerkie. Kanga Moses, thank you for joining us. You see Fragrance and More, Victor. You are all welcome. Kwame ATP, thank you for joining us. Thank you. Frank Travels, thank you, thank you, thank you. This is the maiden edition of The Real Issue, and we are here essentially to talk about the state of affairs of your investment. Now, most of us have heard the recent issues in our financial space in our country now. We've all heard about mark-to-market, we've heard about haircuts and domestic debt exchange and all. And we want to understand what these phenomena, what they have to do, how they affect our finances, how they affect our investments. And so we are starting off our maiden edition of The Real Issue with that, trying to understand all of these concepts and really apply them to our lives and see how best we can move forward from there. And so welcome again. I see more people joining us. Thank you. I acknowledge all of you for being here. Thank you so much. Thank you so much for joining us this evening and making a date with us. And so we'll be joined by our guest, who is Mr. Yausefa. Mr. Yausefa is an experienced investment banker who has over 12 years experience in investment in private equity, in pensions management, mutual funds, and so on and so forth. And so I will not be doing this alone. I'll be joined by Mr. Yausefa, who is currently heading the pensions team at UMB Investment Holdings. And so thank you so much. We see Mr. Yausefa has joined us. Thank you, thank you, thank you. Now I'd like to acknowledge that The Real Issue is powered by Certus GH, and it is proudly sponsored by Certus Media, Upavon Concept. So for all your graphic designs and website designs, just link up with Upavon Concept. Follow them on their social media handles at Upavon Concept. And then also Frank Travels for all your private tours and group tours. Follow them and reach out to them at Frank Travels. And then also for all your events, if you need drinks, you need water, whatever your needs may be for events, reach out to Courage Convenience Store. They are on social media at Courage Convenience Store GH. And so thank you again for joining us. We had a scenario about Adwoa Yeboah. I want to believe most of our audience, or I like to call you neighbors, most of my neighbors were able to listen to Adwoa Yeboah's story. So for the benefit of those who did not listen or who have not heard Adwoa Yeboah's story, I would just like to share it briefly with you. Now, Adwoa Yeboah was in her office one day and was approached by a salesperson from ZNF Financial Services. And with all the excitement in the world, Adwoa Yeboah just decided to sign up after hearing 30% after 1 year. She waited for 1 year and went to ZNF Financial Services, only to be told that instead of the 26,000 which she was due, that is her investment plus the interest, she was now going to get 18,000 cedis. With all the heartbreak, Adwoa Yeboah is wondering what she should do. Should she wait and see what happens, or should she count her losses and withdraw her money? I want to believe some of you can relate with what Adwoa Yeboah's experience is. And so we would want to share ideas, we would want to see how best we can help one another sort our situations going forward. And so thank you again. I see more people joining us. Thank you. Thank you. Mr. Sefa is here with us. And please keep your comments coming. Keep your comments coming in. Keep your comments coming in if you have any questions. please let us know. We would be here to address all your concerns for you. Yeah, 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 yeah. Mr. Yeah.
Yeah. Thank you so much. Thank you so much. And apologies for uh, being being in the driving seat whilst engaging with your neighbors. I just had a little issue that I had to attend to, so I sincere apologies. But I would pray and hope that Vodafone data and reception gives me the best of treatment whilst I'm on the road, so that I can also actively contribute and engage with you, Ayerkie, and then our neighbors. I think I'm struggling to hear you. All right, so basically, can you hear me? Yeah, yeah. So basically, just to start off, right? I mean, investment simply means putting resources or placing resources in a particular venture with the anticipation of making some returns or some growth or some profit from that particular venture. So it could be you putting your cash in treasury bills or bonds, or lending your money to somebody if you want to lend a money lending business or some sort, or even buying shares and equities and whatnot. It could also be you deploying your skills or availing yourself to maybe somebody who needs your skills or your resources for a particular venture with the intention of either making some benefit or profit from it. And it could also be you also deploying your assets. So let's say if you had a car that you also wanted to use for a taxi business or a ride-hailing business like Uber, Bolt, or Yango, with the intention of making some returns or profit from it also, you could also consider that as an investment. And then again, also, I mean, there are other things that people also consider as an investment. For example, people can consider education as an investment. So people can see that they invest in time and resources to educate themselves, either formally or informally, would enable them upgrade their skill set so that they can gain some additional skills that they can also be of value to themselves or their employers. So I think these are the various forms of investment that I would want to touch on. Thank you.
those of us who have the different perception of about what investment is, with this clarification, I think we've been enlightened a bit about what investment is all about. Now, yeah, to the controversial issue, once this guy right, the controversial issue, now in October, late October, and that Suggestion Commission issued a directive to fund managers and other institutions to go by mark to mark, which is one of the things that has affected various investments. Some institutions of budget trending negatively in the media because please, what mark to market?
Yes. Thank you for the question. It does seem a bit loaded, but I'll try to be as straight to the point as much as possible. Can you hear me?
Yes, I can hear you. Yeah.
Okay. So just to give a bit of background, typically for any possible can you hear me?
Okay, now we can hear you.
Yes. Yeah. So I say that just to give a bit of context, if you have an investment or an asset, it is always important for you to know the real value or the going value of that particular investment, so that at least that gives you a fair idea of what you are holding and what the worth. Important that the current value of that instrument is reflected at any point in time. And so if the value of that instrument does change along the line or does fluctuate, it is always important that the value that pertains at that particular point in time is reflected. So basically, the mark to market is just a valuation methodology whereby securities, typically fixed income securities, reflect their current market values. Headed to the implementation of this mark to market directive, all fund managers used to use the amortized methodology of valuing investment assets. And so you realize that the investments accrues returns or interest over the period. And so if, let's say, your investment you started off was 1 million cedis and was going at a rate of 20%, every single day that interest just accrues upon it. But with mark to market, because at any point in time, the security value can change as a result of macroeconomic factors like inflation, interest rates, the country risk, and any other macroeconomic or even global developments. That those particular happenings are also reflected in the market by way of the securities values. So the mark to market ensures that whatever current value pertains to that particular security, it is reflected. So the regulator, having realized that security values have depreciated over the period because of macroeconomic happenings like rising inflation, rising interest rates, buyers of secondary market instruments also were using the mark-to-market methodology in valuing and pricing securities. So it wouldn't be fair for holders of that particular securities, for example, fund managers who manage collective investment schemes like pension, mutual funds and unit trusts, to use another methodology apart from the mark-to-market. Because mind you, when these fund managers are selling or trading these securities, they are going to use the mark-to-market values. So it is important that there's some fairness or equity in terms of the methodology that is being used. So in a nutshell, it was on this basis that the regulator um, gave a directive that the mark-to-market value should be used. And internationally, I mean, financial best practices, it is always important for the real value of the security to be reflected, and this being the mark-to-market valuation methodology for typically fixed income securities. So thereby, fund managers being asked to use this directive. So in a nutshell, that is the reason for the mark-to-market and basically what mark-to-market means.
Please let me know if the sound is better now. Hi, yeah. Can you hear me?
Yeah, I can hear you now.
Can you hear me now?
Yeah, I can hear you.
Okay. So now we've heard the elaborate explanation. What? So now let's take Adwoa West situation for instance. We understand that at the end of the day, there's been a directive which you have just explained the mark-to-market and how it affects our investment or how it now going to affect the investment. Taking Adwoa West instance for Adwoa West case for example, that's what's accounting for the loss in value because instead of 6,000 now it's only getting 8,000. What still can't hear me.
Okay. Yeah. So for her situation, I mean, it would depend on the kind of instrument that she had invested in. So, for example, I'm assuming this is a collective investment scheme. All right, so like a mutual fund. So, sorry.
Hi, Al.
Yes.
Okay, please, can you hear me now?
The volume is perfect now. I can hear you now.
Okay, thank you. Thank you for
I thought
bearing
it was on my end.
No, thank you for bearing with me.
Oh,
Okay,
okay. Okay, great.
so we're looking at Adwoa Ebot situation. So it was a mutual fund, yes. Does it mean that it is only those who have mutual funds? I mean, even talking about mutual funds, sometimes people wonder what mutual funds. They think it's just probably a particular type of investment product that a company has. But mutual funds are all part of what we call collective investment scheme, where
Yeah.
you are literally pooling funds together. Let's say we are 10 people or we are 20 people and we all pool our funds together. Somebody has 1 million, somebody has 20,000, somebody has 5,000, somebody has 20 Ghana cedi, and then we pool all of them together. I mean, whatever amount we have at the end of the day, we give it to the fund manager who manages that on our behalf. And so that's where collective investment scheme or mutual funds come into play. Now, does it mean that with the mark to market, it is only the mutual funds that are affected? Just for those who want to know. Yeah. Yeah.
Yes. So for the mark to market valuation methodology applies to all kinds of investment instruments.
Okay.
So for fixed income instruments like treasury bills, bonds, and then any other fixed income instruments like cocoa bills, it also applies to equities and all that. The mark to market basically is just like another name for the fair value methodology. So typically, just like I said, it just means that the current value of the security, the market conditions should be reflected in the valuation. So it applies to every single security. And let me just give an example.
Okay.
If let's say you bought stock of what company can I use? Let's say let me use Fan Milk for example, just for example purposes. And you bought the value at the time of the purchase, the value of Fan Milk was, let's say, 5 cedis, and you bought 100 units of Fan Milk. So that is 500 cedis.
Yeah.
Yes. So you bought that in January, and so that's what you held. And in December now, you would want to value your investment because you feel like, listen, the year is coming to an end. I'm taking stock of what I've invested so far just to see my net worth, to see if I can rub shoulders with Despite and Dangote and Bill Gates and Co. You know, because I've also made it. Value your investment. So remember, in January, you bought 100 units at 5 cedis per share. That gives you 500. So in January, your total equities holdings of 560. Now in December, over the period, Milk has done so well and has paid dividend. The share price too has risen to about 10 cedis per share. If you were to value your Fan Milk investment, would you use the 5 cedis valuation, the price that you bought it, or you are going to use the 10 cedis value at now? I mean, of course, I'm sure all of us will use the 10 cedis because that reflects the current market value. And if you were to even decide to sell your shares, you are not going to sell it at the 5 cedis that you bought. You are going to sell it at the 10 cedis that is going at the market, or even more, per whatever analysis you've done, because you see that it will hold a lot more value. So basically, what you are doing is that your valuation or the value that you are assigning to it is reflective of the current market happening. So the current going rate of that particular security. So the same thing applies to your fixed income securities like your bonds. So for bonds, there's an inverse relationship between interest rates and then the coupon of the bond. So if you have a bond that you initially bought at initial issuance, that was going for 18%. And at that time, inflation was, let's say, 50%, and interest rates were around 70%. So this bond was a good buy. And we are looking at interest rates of T-bills going above 30%. Inflation too is the range of 40 plus. That means that bond that you bought that was yielding 18% interest now, the value has dropped, because if you look at the current T-bills on the market, they are above 30%. So if anybody let me just use the name, I see Nana Obri. If Nana Obri wanted to buy that bond of mine that was going.
Hello, yeah.
Can you hear me?
Yes, I think so. We lost you at the mention of Nana Obri.
Oh, okay. All right. So I was saying that, I mean, for example, for fixed income securities like a bond, if Nana Obri wants to buy my bond, and having in mind that inflation is now about 40%, treasury bill rates are now about 30%, and my bond, when I bought it some years back, was going at 18%. Nana Obri obviously would expect to make something in the range of the current. I don't care about how much I bought it being 80%. And so Nana Obri will want to make a decent return on it. And so Nana Obri, in a way, is applying the mark-to-market methodology or fair valuation methodology in valuing that bond of mine, because he wants to make a realistic return because of how inflation is now, how interest rates are now, to reflect the current macroeconomic conditions. So in that way, being the seller of that bond will definitely make a loss because I'm going to sell it higher than how much I bought it for. And so that is one of the, I would say, the cons that come with that particular valuation methodology when, of course, interest rates go up. But if you should flip the script and interest rates drop lower than how much I bought my bond for, once I know Aubrey approaches me or approaches the broker, I'm going to sell it at a price lower than how much I bought it for, because obviously the rate of return or interest rates have dropped lower than how much I bought my bond for. So then I can sell it to Nana Aubrey and still make a margin on it. So if inflation now was, let's say, 10%, and interest rates was probably 12%, because I bought my bond at 18%, I can sell it to Nana Aubrey for 15% and still make a spread of about 3% or more. So that is how it works. I mean, that's when interest rates goes up as against the coupon, you can either make a gain or a loss. And so these things or these developments reflect in the value of the bond. So that's more like underscores or is a reason for the decline in the value of let's say my investment in maybe my mutual fund or any other mutual fund that you invest in, because the holder or the fund manager has invested in this kind of security. And so at any point in time, if he's going to value his portfolio, and we are in times like this where bond values have dropped, it is going to affect the fund. And that also means that my investment or the related investment in the fund also is going to be negatively affected. So that accounts for the fact. The same thing as stocks. For example, like I made the case of the family stocks. If it goes up or comes down, it is also going to affect my portfolio value. So the same thing applies.
Okay. Thank you so much, Yao. I'd like to acknowledge all of you. I see MFR _H, Kinels, Na Afrak, Regina Mensa, Nana Obri, Manyesi, and Bimpoma, Rajiv, Subros, and then Amapari, Real Mean Babe. Thank you all. I see all of you, and I acknowledge. Thank you for joining us. Please, if you have questions, kindly keep them coming. Keep them coming so that we can help address them before we leave this session. We want to make sure that it is practical to us. We want to make sure that we understand what it means to our investment. Now we have heard Yao tell us what it means and how it's going to affect us. If the rates were high, we would have been gaining. But now that there is a mark-to-market situation where we are now getting lower, lower returns, if I can say so. It means that we are also getting lower returns on our investment and all. But the most important thing we want to do here is to help you understand what that means to you as an investor. If you have any questions, please send them through. We will read them and then we'll address them. And so we'll be here waiting for your questions. Now, Yao, just last week, I believe that was Friday on the 2nd of December, I think after watching football and all, then we hear of Ghana's domestic debt exchange. After going through all of this mark to market where investors are wondering what is happening with their investment, we haven't even had the time to recover from it. Even going back to 2019 and all, after the financial sector cleanup, I think we are also going through, we are still recovering from all of those ones as well. And then now mark to market. Then to top it up, there's debt exchange. How is that going to affect my investment in the bank here? How is that going to, if there's a haircut, whether it will be a punk or it will be a sakura, we don't know whichever form it is, but how is that going to affect my investment in the bank? How is that going to do that, please?
All right. And so, before I address that, your question, let me just clarify something. So, with regards to the mark to market, it isn't really a bad thing. Like I said, it's only a way of valuing securities whereby the current going value of the security is reflected in your valuation. So, in periods whereby interest rates fall as against the value or the coupon of a security, your security value is going to shoot up, and so you are going to make more in terms of the value of the bond. Or if you had invested in a fixed income fund, for example, you are also going to make more.
Okay.
The interplay between the coupon or the yield on the bond, and then also inflation, and also general interest rates and general market conditions. So that is what plays an impact or informs the deposit in your bank account. Just to give some background, so banks typically would hold your funds regardless of whether it's in a fixed deposit or it's in your savings account or it's just cash lying in your account. Banks typically would use that fund to invest in loans. So by lending to people, that is individuals or businesses, or they would purchase securities with it. So this could include bonds, Government of Ghana bonds, treasury bills, and other instruments issued by the government. Right.
Okay.
And so this is how they can pay some returns on your investment for you, whether it's even in a savings account or it's in a fixed deposit. Now, with this new development, which is the domestic debt exchange program, it mainly has to do with institutional investors. So, bonds, like we all know, are held by both individuals and institutions. Individuals like yourself, myself, I can see Onyame, and then Rubinho, and I know we all can purchase bonds, or we all probably maybe hold bonds at one point, one time or the other. Likewise, also institutions like banks, fund managers, or even an institution that you would set up would also purchase a bond. Now, this particular domestic debt exchange program only applies to institutional investors. So, after deliberations and other considerations, the government and the Ministry of Finance decided that this would only apply to institutional investors. So, with your funds at the bank, what would happen is that the bank at the cutoff date would have to exchange the current bonds that it holds. There's a tall list of bonds that it holds.
Okay.
0%. The subsequent year, I think 5%. The next year, I think 10% and onwards. And now what will happen is that you are not going to lose your money. However, as a client or a customer of the bank who would either invest in fixed deposits or savings accounts, the interest that the bank will pay on your investment would literally reduce a bit. So they were paying averagely, let's say, 5% on your savings account. That will reduce because you know what, banks are not earning that much of returns from the bonds again like this because of the example explanation that I gave. Secondly, also, if you were investing in fixed deposit and you were earning 20% per annum, because generally across the market, institutions like banks and other financial institutions are not earning that high rate of return on their bonds, they can't also pay you that 20%. So it would also have to reduce. So that's what will happen. But in terms of liquidity and you having access to your funds, I mean, you would always have access to your funds because the measures that the government and Bank of Ghana, being the regulator of banks has put in place or regularly puts in place, there's always that check and balances and adequate liquidity in place to ensure that you can always have your funds as and when you want it. On the other hand, to extend the conversation, if you are considering your investments with other collective investment schemes like mutual funds or unit trust, again, you have access to your money. Your money wouldn't go anywhere. But just like the banks, because the fund manager now will not be able to earn high rates of return on their bonds, it's also going to affect the rate of return or the growth of your investments. But like I said, you are still going to have access to your funds and your money is not going to go anywhere. So it's important that we don't panic. And because once you panic and you go for your funds, then of course, whatever drop in value as a result of the market development and the market valuation methodology is going to crystallize or is going to take full effect. So if you don't really need your fund, I mean, leave it in there. It's not going to go away or dissipate.
Okay. Thank you, Yao. Now we have some questions. I would like to read out so that you help us with it. From Efia Jewa Frempong, she said, "So please, should we withdraw our investment?" I believe you just answered that. I'll come with a follow-up question to that particular one. But you just said we should keep calm, we shouldn't withdraw. But I'll come back with a follow-up question. Then Kwame ATP says, so what is our level of exposure and what is the impact of this debt exchange on our investment? How do we handle it in the foreseeable future? Yeah,
thanks for the question. So, like I said, for individual investors like us, you and I and Kwame J, who asked the question, individual investors are excluded from this domestic debt exchange. And so you would have access to your bonds. If you hold bonds currently, nothing is going to happen to it. You are not being considered in this particular transaction or domestic debt exchange. It's only institutional investors. So there's no need for worry or panic. If you had invested or purchased these bonds through maybe a company, or maybe you had a company registered in your name through which you purchased the bonds, then of course you are going to be classified as an institutional investor, and as a result of that, you would have to participate in this domestic debt exchange.
Okay, so that's a very interesting question, a straightforward question from Rachel. Rachel Mom 123. She's asking, so what is the way forward? Is it advisable to still invest?
Yes, it is advisable to still invest. And Rachel, if you remember at the beginning, I gave a brief explanation on investment and the various kinds of investments that we all would consider. So it is advisable and still important to invest, even in times like this when the market is volatile and also inflation is rising. Because then again, if you don't invest and you keep your cash either in your wallet, in your purses, under your beds, or even in your bank account, remember that the cost of goods and services is going up. So that 100 cedis that you had under your pillow yesterday can't buy what it used to buy or you could afford about a month ago. And so if you don't really need that money, then of course you can put that money aside in a vehicle that will enable you earn return, so that in the future, either short, medium term, or long term, that money would grow and you can use that then to purchase other goods and services, which at that period in time would have increased in price or value. And it's also a way for you to also preserve your capital also. Even if you don't have any plans of purchasing anything, but at least you can also prepare for maybe investing in your business or even for retirement. It's important that we just keep on investing. We just have to be cautious, do our due diligence, and also most importantly, understand whatever we are investing in. So whether it's a fund or an instrument investment or even a business, or even lending to somebody, it's important that you understand the terms and conditions and that particular investment vehicle before you part with your money.
Okay. Then Anan is asking, in the speaker submission on the inverse relationship between coupon rate and investment rate, okay, I believe it says, please, can he clarify what type of interest rate he's talking about? Is it the policy rate? Okay, I believe the inverse relationship you were talking about with regards to the bond. So the person is asking if you could clarify what type of interest rate you are talking about, whether it is the policy rate.
Yes, it's the policy rate.
Okay.
And as we all know, like economics 101, the policy rate is what informs or feeds into the interest rate on treasury bills and newly issued bonds and other instruments. Yeah, and we also are aware of what impact or relationship the policy rate also has with inflation. So as inflation inches up, the policy rate is also revised or adjusted to also match that. I mean, it doesn't always match inflation rate also. I mean, given the times and periods that we are in now, but it also adapted so that other investment instruments like treasury bills also match the prevailing rates at that period.
Okay, thank you. Then to Eugene Kwabena Owusu Anane, he says, is it advisable to continue investing in, I believe this is a mutual fund, for the purposes of for ethical reasons? I wouldn't want us to start naming funds that belong to certain institutions. So I'm going to use a mutual fund there. So is it advisable to continue investing in mutual funds now, looking at the current economic situation? Who benefits the most, i.e. the investor or the bank?
I think it's not. I can't give a straight jacket answer to that because, like I said, everybody has their investment objectives and plans, and so it would depend on your investment objectives and plans, and then even also the type of mutual fund. So, is it a money market fund? Is it a bond fund? Is it an equity fund? Is it a balance fund? I mean, all these funds are different, and also when you add the mix of your investment objective and plans, also that also further needs a lot more detail. But like I said earlier on, it's good to invest, but you also need to do your due diligence and also speak with the fund manager or whichever broker is selling or retailing that particular fund or investment scheme, so that you understand what the scheme, how the scheme works, what risks are involved, and all that, and then also share with the investment representative, that licensed investment representatives, your plans and objectives, so that they can also advise you properly on what particular product will be ideal for you before you invest in that, so that at least everybody is clear on whatever they are going to.
Yeah. Just on a lighter note, I've had to, engage people, and then when they have to fill, usually for investment accounts, you have this, most of the time it's about 5 questions. That's the KYC, know your client, that talks about your investment objective and your investment knowledge. And most of the time some people have different perception of it. And so when you're asking them about their objective or in the form, most people just want to take just anything, other, and then move on. But I believe that from what you are saying, this is also the best time to fully disclose what your investment objective